To the extent that you want to try and guide that valuation, because as a founder, you do. Of course, you let the market tell you what it should be, but you're also going to try to simultaneously do the things you need to do to guide it. But I think a smart founder will think 3 or 4 steps ahead. And what I mean by that is, don't just think of the money you're going to need today. Think of the money you're going to need in a year from now, 2 years from now, 5 years from now, and what the optimal valuation will be today to achieve the goal in 1 year, 2 years, 5 years, 10 years, and eventually an exit. And coming in with too high a valuation, even if the market might bear it, sometimes with the wrong strategy, because it'll make it that much harder when you get to, maybe at phase 1, you're talking to me, and then at phase 2, you're going to Lloyd. And if you went too high in phase 1, it makes it much more difficult to do business with Lloyd in phase 2.
This podcast is brought to you by Pragmatic Solutions, the leading iGaming PAM platform with a modular approach, including many benefits like a fast, secure, and scalable API-based platform, integrated with all major third-party products and services. Make sure you head over to Pragmatic Solutions and join our smart thinking.
This podcast is brought to you by Pragmatic Play, a leading game developer providing player favorites to the most successful brands across the industry. With an award-winning multi-product portfolio of slots, live casino, bingo, virtual sports, and more, Pragmatic Play is powering up new possibilities of play through one single API. Visit pragmaticplay.com and discover your favorite every time.
Boom, we are live. Vested Interest is back in action here, celebrating its summer edition. Lloyd, Benjie, great to have you guys here. Lloyd, how are you doing, first and foremost?
Never better.
Amazing. Benjie, you're in a hotel room as per usual. Everything is okay on your side?
Yeah, ready to rock and roll, dude. Let's do it.
Let's do it, my friend. And I'm back here in Sweden, celebrating my yearly celebration straight into the woods here. So I'm locked and loaded, ready to go here as well. All right, first and foremost, we are going to take on the first topic here today, the tax hike implications now that we see after the proposed tax hike that we see in Illinois. Lloyd, what's your commentary on what's going on in the state of Illinois at the moment with the tax hikes that are being proposed?
I have a bit of a non-answer, but hopefully at least someone finds it interesting. There are other people who are better positioned to prognosticate on exactly where the tax rates will stand, what other states will do in terms of tax policy, what the timelines for that will be, what the impact on operator gross margins and unit economics will be. To me, the most fascinating aspect of this story to track is, in theory, the operators have said they will likely pass on higher taxes to customers in the form of either decreased bonusing or just less favorable odds. You increase the house edge enough through the form of less favorable odds, and you can kind of counterbalance tax hikes if and only if customers are inelastic in their demand for your product and willing to consume it at the same level even when the price declines. And what this makes me think about is the concept of price sensitivity with respect to sports betting. We all know what price sensitivity means with respect to pizza. As pizza gets more expensive, I will eat less of it, or I will substitute hamburgers in for it more freely. We know what the cost of a piece of pizza is. It's the number of dollars you take out of your pocket in exchange for the piece of pizza. But what's the price of a sports bet? It's a little less straightforward. I think, a statistician would say the price is the house edge, is the VIG, is the amount you expect to lose if you place that bet many, many times. But you're not placing that bet many, many times. You're placing it once. And so I think what we're about to learn is just how price sensitive or not price sensitive sports betting consumers are. If operators are able to offer, totals and spreads on Sundays for NFL at minus 130 on either side without a downtick in demand, suddenly a GGR tax hike doesn't seem so important. On the other hand, if going to minus 130 on each side on spreads and totals means demand drops off a cliff by 90%, then obviously you're going to see some real implications for the bottom line. So for me, the big story here that is yet to be told is how price sensitive are American sports betting customers, and to what extent can operators pass on increased costs to them through the form of wider spreads and larger house edges.
Yeah, I think that it's an interesting point and an interesting dynamic, because if you look at the whole sphere of real money gaming and you take sports betting, Then you take daily fantasy in another sphere, which obviously has more of a national following. The VIG, if you want to call it as such, on the daily fantasy is usually a bigger spread than what we see typically on sports betting. Then again, within the sports betting dynamic, in theory, one can argue that you're competing with the illegal bookmaking dynamic, which will come in without the tax hike implications, or for that matter, any tax implications other than the local tax, whatever jurisdiction they're operating out of. So there's a lot to unpack here. And I think, you also have to take into consideration, Lloyd, not all customers are created equally, right? So a real Square customer might not really notice if there's an extra 5 or 10% VIG worked into the pricing that they're being offered, because they're a Square anyhow and they just don't pay attention to it. Whereas there'll certainly be a segment of bettors who will notice it if there's an increase. And, you're right. We'll begin to see how price sensitive the market is, but it's still a relatively uneducated market. And as that market becomes more educated over time, in theory, paying higher VIG or higher pricing on the dollar that they're spending at a given sports book might become an issue. And then, look, we've already seen within the global landscape the quote unquote race to the bottom in competitive pricing. And some of this may further amplify the positioning of the sports books that tend to target the Square bettors. And as alluded to, it's also going to be interesting as we see more. This isn't just an Illinois question. Of course, there's activity in Massachusetts. And, as dominoes fall, one would surmise that the tax hike analysis is something that's being discussed on a state-by-state basis across the country right now. And it'll be an interesting dynamic just to kind of see how sports books, tier ones, tier twos, and others begin to strategically position that into their overall analysis and strategy of which states they should go into, which states they shouldn't go into, which states they should be iGaming only as more states open up. So all of this is an ongoing and a moving dynamic and not a question that gets answered overnight.
I think Benjie brings up the really good point of the black or the gray market. And it's important to remember anyone between the age of, 30 and 50 or so in the US grew up with some form of technology and internet connectivity. And probably, if they like sports betting, some form of either connectivity to a, Bovada type offshore book that is taking deposits, or more commonly, certainly in my social circles, what are called PPH, pay per head shops, where someone licenses or leases the use of a website that really is just tracking units plus or minus on a ledger, and the actual transacting takes place offline. You settle up in cash. More recently via Venmo, used to be, cash or whatever it would be. And in my view, and I would love to know if Benjie has a different view, I think the reason that the black market retains customers today actually has very little to do with pricing. Certainly the fact that customers don't have to pay taxes on their winnings doesn't hurt. But I would argue that where the black market wins today is in habituation. People are used to using the sites that they know. Ease of sign up and use. The nature of being offshore and black market is you probably are not doing the same level of KYC AML, and particularly on a PPH site where you're not even depositing and withdrawing and you're transacting offline, the sign up process and the process for logging in, which does not require any geolocation or two-factor authentication, not to mention the ability to bet on credit. Those are the reasons why so far I think the regulated market has had trouble removing some of the folks from the black market. I think to date, the regulated market has actually probably been to some extent winning the pricing battle, not because they have lower margins, but because the offshore guys have always been slow movers, more reluctant to do micro betting, same game parlays, any sort of correlated lottery ticket style outcomes where someone can win a really large amount. But this could be a bit of a turning point, as Benjie alluded to. It's still a relatively uneducated market. And if as the market gets more educated, people who are already habituated to the black market, who already like signing up and logging in and placing a bet with much lower friction, if they then to start realizing that in Illinois, DraftKings is dealing minus 130 on both sides of spreads because that's the only way they can accommodate a 40% GGR tax, whereas their offshore PPH site is doing minus 105 on both sides. Maybe the pricing on that part does become a bigger differentiator. I don't know, but I do think there is a lack of appreciation in general for what the black market offers in terms of retention. just by providing a path of least resistance for many of probably the most valuable users in that 30 to 50-year-old or so cohort, that path of least resistance and frictionlessness of the black market is really, really difficult to overcome.
Right. We published a story the other day, which was basically a report that was written by the Campaign for Fair Gambling together with YieldSec. And they studied the channelization rate in 3 particular states. So New Jersey, which has a long tradition of regulated online gambling, New York, which is a new entry and only offers regulated sports betting, and Minnesota, where there is no legal alternative for online gambling. And what they found out is in the state of New Jersey, you have quite a lot of different operators, but you have only around a 62% channelization rate according to this report, which alludes to that 38% of all GDR that is generated goes to the offshore. Whereas in New York, only 31% of all GDR that is generated online is within the regulated environment. So that means obviously 69% goes to the offshore. And in total, between the 3 states, $9.5 billion in 2023 alone was generated between 860 offshore operators to the black market, essentially. And in total, $41 billion was generated to the offshore market in all states in the US in 2023. So it seems that the black market operators are thriving in this environment at the moment, more so perhaps going forward in the future. Is there anything DraftKings, FanDuel, the incumbents can do to combat this if we assume that tax rates potentially will go up in several states, which again can potentially mean that the product offering and the pricing is at a disadvantage? Benjie, what do you think? If you would look into the crystal ball, do you think the channelization rate will go up in the coming year, go down, and will federal action be needed essentially to stop the offshore from taking over?
So, look, when you say the offshore from taking over, I think that's probably not the most accurate way to phrase it. The offshore has been there in perpetuity for who knows how long, since sports betting's been around in the U.S. and of course, the legislative.
I say that, sorry to interrupt you, but I say that because from a European perspective, that is very much the feeling right now. If you look at the environment over here, it is the offshore guys that are really taking control of the markets now at the moment. And I'm just wondering if that could potentially be something that will happen in the US as well, if nothing is done.
Yeah, look, I think the black market in the U.S., maybe the right word is it evolves, right? As messaging betting becomes more prominent and as different forms of cryptocurrency betting become more prominent within the black market and are slower to adapt within the legislated markets. But, look, I don't really pay all that much attention to any of the reports that I see, whether it be the AGA, who says that the black markets are losing, or the report that you allude to that says the black markets are winning. I don't know how these guys are getting their numbers. I imagine they're doing some form of polls. They're making some best guesses, which is somewhere between throwing darts against a wall and making an educated guess. But what I can tell you is that the black market, based on my informal conversations with people who are in the black market in the U.S., is thriving. When PASPA was repealed almost 6 years ago now, the general sentiment amongst the folks who run the roost within the black markets was, well, we've had a great run. Now legislation's coming in. Our businesses are going to slowly disintegrate, and in 5, 6 years, 10 years, whatever it is, we'll be out of business. And we had a good run. The exact opposite has happened. Their businesses have grown exponentially, right? What are the reasons for that? Lloyd alluded to some of them earlier. And another reason for that is that just betting has become socially acceptable, right? What was once viewed as something that shouldn't be done is now being viewed by the masses across the U.S. as culturally acceptable. If we can do it on ESPN, we can do it elsewhere. And to a certain extent, the DraftKings, FanDuels, and others are doing all of the advertising, and the black market is indirectly benefiting from that in a significant capacity. And one other point that I would make to Lloyd's commentary earlier regarding the black market is that another reason why the black market is retaining customers is they're more experienced bookmakers. And then, yes, they don't have as advanced in some areas such as same game parlay. They haven't evolved. They've been more hesitant to evolve in those areas. But when it comes to straight up bookmaking, they've been doing this a long time, and they are not scared to take a bet. So whereas a FanDuel, a DraftKings, or another, whether they advertise it or not, is going to minimize how much you can bet on a college basketball game on a Thursday night, you can probably get a whole lot more down on a Division II college basketball game or a non-Power 5 Division I college basketball game on a Thursday night in the gray market than you can in a FanDuel and a DraftKings. And they benefit from liquidity. They have national handle. They don't have to worry about trying to compartmentalize it on a state-by-state basis. They don't have the tax concerns, obviously, as per our previous topic of conversation. And there's some real inherent advantages for operating within the black market, and those markets continue to excel. So I'm not sure if I've answered your question, but those are some points on my end.
Just to add to that, I could not agree more with the very first thing Benjie said, which is that I'm always suspect of all the numbers that I ever see put out. With all due respect to whoever put out the report I'm about to reference, I saw one the other week that said after DraftKings, Bet365 is the number 2 most recognized sportsbook brand in the U.S. And I can assure you that is not true. I don't need to look at the data. I don't need to look at the surveying methodology. I can assure you. I think, to Benjie's point, the black market is thriving for all of those reasons, but I don't see a risk of it taking over per se. I see a rising tide lifting all ships to some extent. You have to remember with the younger generation, with the kids fresh out of college, newly 21 that have existed only in a world with heavy inundated advertising from DraftKings and FanDuel, tons of promotions. You turn on ESPN, there's sports betting advertising there. You go to Yankee Stadium, you go to Madison Square Garden, the apps are advertised there. When I go to bars in New York City, I look at the tables around me during a Knicks game. Everyone is on DraftKings and FanDuel. Nobody is on offshore sites. The meme accounts that I follow that post things like new New York City Finance Bro starter pack that include DraftKings and FanDuel logos on them now, next to Rolex watches and Loro Piana cashmere sweaters. I think there might be an underappreciation for how well these brands have done that are not just gambling brands, by the way. They are media and entertainment brands. Fanatics doesn't just offer sports betting. They sell tickets and merchandise and collectibles and live events and who knows what else. And DraftKings similarly now does lottery and NFTs, and you can live stream some of the games within the app. So I see no risk whatsoever that the black market is, quote, taking over. I just see continued growth and incredible opportunities for TAM expansion for both parties in parallel.
I would still like to draw some parallel to what overregulation can lead to if you look at the market like Germany, where the market is completely overregulated, both in terms of taxes with incredibly high tax rates in combination with limitations on the product itself. So you have the DraftKings of Germany is typical in Germany, right? A household brand and known by all bettors and gamblers for the last 15 or 20 years. But because of the regulation in Germany, you see an ever decreasing channelization rate, and brands like Stake and other crypto casinos are more and more taking a bigger part of the market share. And as both of you guys allude to and point out, there isn't any reliable statistics to what the channelization rate actually is, right? You have in the European markets, you have a lot of the local industry organizations that are estimating and kind of creating surveys and trying to figure this out. But there is a really interesting upcoming startup that is trying to answer this question. Actually, I spoke to Benjie about this. It's a new company called Blask, which is creating this Blask index, where essentially they are gathering all the available public data, SEO trends, and a lot of the different data points in order to try to estimate the sizes of both regulated and unregulated gambling sites. So say, for example, you go to Brazil, you'll be able to see all the 188 active operators in Brazil listed and rated from 1 to 188, and an estimation of how much EGR they produce. And according to Blast, the founder there, they have an error margin of 10%. Right, so they haven't launched the US yet, But once they do, it would be really interesting to see what the estimated numbers are, their kind of ranking order between the regulated and unregulated numbers. So I think it will call for potentially on a follow-up here when we have more information on this front, because that is going to be the closest we can get to an estimation of how the market actually looked like.
I love what he's doing over there, and I think it'll be super interesting to see what those numbers are globally in various markets across Europe, as you allude to, and of course in the US. But look, the US is still, it remains in its infancy, Pierre. It's hard to compare what's happening right now in Germany with what's happening in the US because Germany is so much further along in their journey. And look, as I said earlier, the US customer is still emerging. You know, this next generation of bettors and punters in the US have, to Lloyd's point, grown up with the DraftKings and FanDuel's ad and advertising and are embedded in those brands from a media perspective, from a social perspective. And look, we're still in such early stages. We only have iGaming in a select number of states. So certainly, if you want to go and play online casino, unless you're in one of those few states, you have no choice but to either not play or go to the offshore, right? So as more and more states continue to legislate in different ways, there's going to continue to be challenges of state-by-state legislation. The increase in tax hikes is doing no one any favors as it pertains to maximizing the opportunity for the sports books, but it's a balancing act between the state legislators, the sports books, the leagues, the data providers, and everyone wanting to have their piece of the puzzle. The ongoing legislation of additional states, be it in sports betting or casino. Where will sweeps fit into the mix? Where will, cryptocurrency fit into the mix eventually? All of this is a moving dynamic, but it's a little bit difficult to compare what's happening within the US to what's happening in any other markets because it's still in its infancy.
Yeah, I agree. And to add, look, I actually wasn't familiar with the startup we're talking about. It sounds like a really interesting exercise. Frankly, every Wall Street investment bank with an equity research group in the US has very similar detailed tables and geographic breakdowns. Granted, they don't make them available for use outside the walls of that institution. But whatever that data is, I would be interested to see it. But I don't think any numbers you could tell me would change anything about what Benjie and I do every day. My bet is that 10 years from now, GGR per capita in the US, when you include sweepstakes, lottery, casino, sports betting, poker, whatever, will be far greater. Whether you do or do not include the black market or how you slice it, it will be, multiples greater than most people currently think today. And as long as that's true and we make investments that move along that trajectory, whether New York is 38 or 36 or 49% channelized, to me is, intellectually interesting, but not material to how I would make early stage investments. Certainly if I were trying to, be a day trader and look at DraftKings FanDuel price and make moves in and out of those companies on a short-term basis. But if you're investing with a 5, 7, 10-year time horizon, I think your bet is that more people will be using these products more often in the future as a category, that the products will be more profitable and also deliver a better user experience to people in the future. And the last comment I'll make, because I know we have a few other topics to get to, what I love about the black market is that it is the most fertile ground for innovation and natural product market fit that is not filtered through the lens of the economies of scale needed to achieve licensing and regulatory compliance. And so while it can be unfortunately very difficult to deploy institutional capital into some of these companies that are growing like rocket ships in the black and gray markets, we study them very closely. We have an entire Slack channel dedicated to great product developments and innovations that we see take place in the black and gray market that were able to take place there because a startup with just a few dollars didn't have to go through the same incredibly arduous licensing and compliance process that they would have had to in the regulated market. And when you see products like that really catching on, you can get a sense for maybe what the best and closest legally, regulatorily compliant version of that same innovation might be.
Right. The North American market can definitely not be compared to another market on Earth, but we can draw some nice clues from other markets for sure. And I'm sure we're going to return to this topic in the future. Next topic, I want to jump over to the world of investments and talk a little bit about how to evaluate your company. Lloyd, what would you say is the ideal process for establishing your valuation at a kind of startup level when raising capital? Have you seen any good examples of this? It can be difficult, of course.
Yeah, no, it's definitely a tough topic. There's a lot of things you should consider, when evaluating how much leverage you have in investment negotiations, founder pedigree, traction, product market fit, opportunity size, number of natural buyers in the market, and things like that. And certainly for, pre-seed founders who are maybe raising more of an angel round, or maybe raising money from a singular corporate strategic investor, there's a whole variation of what the process is for arriving at a valuation, the optimality of which kind of depends on who you are as a founder. There are some really charismatic, amazing fundraisers who, for a pre-seed round of 500K from angels, can set their valuation in a way that most founders cannot. But that's not really the world that I spend as much time in. If you're talking about how do you set your valuation for a proper venture-led seed or Series A round led by a tier one Series A, the answer is you don't set the valuation. You go out to investors and say, here's how much money we need to accomplish these milestones that will get us to the next raise. And the venture capital fund that is leading the round and setting the terms and taking the board seat, they tell you, okay, well, we will give you that much money at such and such valuation. And if you have no other bidders and there's no other suitors interested in a term sheet, then that's your only offer, and you can take it or leave it or try to negotiate it if you wish. Or preferably, of course, you'll have several term sheets and maybe can play them against each other a bit, or have several suitors that you can play against each other a bit, and will bid up the process to some extent. But the answer that I do see a lot of founders miss is that for a proper seed or Series A led by a venture capital firm, the market sets the valuation. And I think sometimes when a founder comes out and says, hey, we are raising a Series A, this much money at these terms, and I say, oh, who's the lead? And they say, we don't have a lead yet. It compromises your credibility a bit, and it doesn't show you're a dishonest person, but it shows you don't really know how Series A venture capital fundings work. And, that's, I think, a factor that sets the tone to some extent for the subsequent negotiations. That's not to say there aren't some incredible serial founders in this space who have so much demand around them that they really are able to go to their existing or new investors and say, hey, guys, we need a few more dollars based on our progress since the last round. This is what I'm comfortable with the valuation being. I'm putting in $500,000 of my own money and setting the terms, and I hope you'll come in. But if not, we have more than enough interest from the other investors. That definitely happens, from time to time. But the overwhelming majority of venture-led seed and Series A rounds have valuations that are set by the market or by the lead investor who is putting in the term sheet, taking a board seat, and coordinating the rest of the process.
Yeah, I think I agree with most of what Lloyd has said over there. I think that, first of all, when you're, to Lloyd's point, when you're starting out, I would say that no matter where you are in the process, Lloyd, you shouldn't be hung up with creating a valuation, whether you're going to friends and family or eventually. You should kind of indicate, here's what we're doing, here's the path forward, here's what we need to get there. And the laws of supply and demand are going to kick in. And the laws of supply and demand take everything into consideration, how strong your business case is, how strong and buttoned up you are as a founder, and how much due diligence you've done, and how many questions you've been proactively answering just by the way that you do business before they need to even be asked, combined with all of the market parameters. And all those things combined together will dictate your valuation. And I would argue that, to the extent that you want to try and guide that valuation, because as a founder, you do, of course, you let the market tell you what it should be, but you're also going to try to simultaneously do the things you need to do to guide it. But I think a smart founder will think 3 or 4 steps ahead. And what I mean by that is, don't just think of the money you're going to need today. Think of the money you're going to need in a year from now, 2 years from now, 5 years from now, and what the optimal valuation will be today to achieve the goal in 1 year, 2 years, 5 years, 10 years, and eventually an exit. And coming in with too high a valuation, even if the market might bear it, sometimes is the wrong strategy, because it'll make it that much harder when you get to, maybe at phase 1, you're talking to me, and then at phase 2, you're going to Lloyd. And if you went too high in phase 1, it makes it much more difficult to do business with Lloyd in phase 2, right? So I think that sometimes it's not about maximizing your valuation as a founder, but also thinking a few steps ahead as to what will be the best path to achieve success for all of us as a collective, myself, our co-investors, the entire team moving forward, and to create the maximum value to create a positive result for everyone involved.
Right. So that seems almost counterintuitive, right, Benjie? Because as a founder, perhaps raising capital, especially for the first time, you want to the attraction is to try to achieve as high valuation as you can in order to give away as little equity as possible, right? But you are saying that actually you need to think much more longer term, because further down the line, when you raise the second or third round, you don't want to end up in a position where you have to do a down round perhaps, or the valuation came in too high, the first valuation, and now you have to try to justify an even higher valuation in the second round, which can generate problems. Lloyd, is that something you can emphasize with as well? Any other comments on that?
I mean, I would say 90% of the high quality companies that are having problems raising in our industry in the current market are having problems raising because their last round was at too high of a valuation, not to anyone's specific fault. And now they're looking at a flat or slight up round, even though maybe the fundamentals don't justify it because no one wants a down round. And we just passed on a deal the other day where I love the product and would potentially use this product 5 out of 7 days a week, maybe 7 out of 7 days a week. But their last round was a 2021 era round at a $25 million valuation pre-launch. And now they want a slight uptick from that. And our reason for passing, or explanation for not diving deep, was we're seeing enough deals at a sub 15, even sub $10 million valuation range right now that have traction and some or completely have achieved product market fit, that there's no way I can justify putting our investors' money into something pre-traction at a 25 or 30 or $40 million valuation. And that's how most, I think, other investors feel when some of these deals come to be. And if you don't have an insider, someone on the cap table that will lead a down round and say, okay, guys, we got a little ahead of ourselves. We need to reset the valuation to get things on the right track. I'm an insider. I'm going to put in $1 million. Who are the other investors? Can we get everyone together? If you don't have that kind of internal champion, it can be extremely difficult to move forward. I think it would be wrong to optimize when raising a pre-seed or seed round for minimal dilution. I think you should be optimizing for probability of success and raising the round that increases your probability of success by the greatest degree. And that includes, of course, dilution, because you need equity to give to future investors and future employees. But it also includes who the investors are, what they bring to the table, how easily you will be able to achieve a flat or up round when you need additional financing in the future. And I know someone who tells companies you should not raise at $1 higher than the valuation that you could confidently sell the company at today. And that is probably very punitive compared to the valuations at which most companies want to raise, which generally are far in excess of what, if they were honest, they could sell that company for with their gun to their head in 48 hours. But honestly, it's probably, pretty good advice. And there's a great Silicon Valley episode, season 4, I think, of exactly this. And a guy, he ends the episode saying, why didn't anyone tell me I could take money at a lower valuation? And his life ended up being ruined because he took money at too high a valuation. And another company is then saved by telling a VC, I want to take your offer, but I want less money and at a lower valuation. And obviously it's a comedy, but very much based on reality.
But, 2 points to that, Lloyd. And I love one of the points that you made as it pertains to part of the journey being who do you have alongside you, who the investors are. And I think that when you're, kind of creating the framework to figure out what the appropriate valuation is, the question shouldn't just be, how do you come to the right valuation? The question should become, how do you structure everything in terms of what you're doing as a founder to maximize the chances of having the right investors at the right valuation? Because you could maximize your valuation or enhance your valuation with less strategic investors, hypothetically, but that might not be doing you as a founder any favors versus creating an offering, not just in terms of what the valuation is, but in terms of how you structure the business that is attractive to the right type of people that can help you grow this collectively with you moving forward to achieve the ultimate maximum outcome. Practical, I have one friend who likes to say, when you're raising money, you want to have very practical valuations when you're raising and have a very impractical exit. And that's kind of the optimal way of looking at this. And I think that's an important dynamic to consider.
Charlie Munger always said, show me the incentive and I'll show you the outcome. And that's what Benjie is referring to, is the incentive structure, which includes your valuation framework, how you structure the company, your advisory board. The incentive structure that you put in place as a founder is really, I think, maybe above all else, aside from your horsepower and vision, what dictates the success of the company.
I'll give one last point, and I'm tempted to say the name of the founder, but I won't because I don't know if this is publicly available information or whatever you want to call it. But one founder who I'm invested with is a second time founder and sold the first company for a sum and now began the second company. And when he went to raise capital, came out and the valuation was X. And I said, I kind of view the X as a little bit high. I mean, who's leading the round? He said, I am. The first million's coming from me. He's raising 1.7. The first million's coming from him. It's kind of hard to argue. So what did I do? I put my money in because his skin is in the game, right? So we're all in this thing together. But as a founder, if you're a founder out there, and the best way to stand behind it is to lead the round yourself, but obviously not feasible for the majority of founders out there who are first time go around.
I know which round that was, and that's looking like a pretty good investment based on where that company is at now, revenue generation wise. But story for another day.
Time will tell.
Final topic of today, guys. We're going to turn the spotlight over to our very own Lloyd Danzig today. Lloyd, you recently closed your second fund here at Sharp.
Hang on, Pierre. Did Lloyd close a fund? I haven't seen any PR around that at all. Are you sure he did?
I think there was a little tweet somewhere who mentioned this, some corner of the industry that mentioned
one of my investors teased me that I have more publicity per dollars of assets under management than any other firm on earth, possibly. And you know what? I'll take it. We don't use a PR firm. It's all organic and works for us.
He certainly does well, Lloyd, on that front, that's for sure. So a $25 million capital raise goal, you overachieved on the goal, and you managed to close this fund too. Lloyd, as a first question to you today, what went into the fundraising process, and how was the environment in raising capital for a fund at the moment?
2023 was brutal. 2024 has been strongly improving, not specific to us, just my perspective on LP appetite for allocating to venture capital and private equity funds. And it makes sense. Interest rates have reached some form of at least temporary equilibrium. Growth stocks have performed very well in 2024. So it feels to people like there's more of an avenue. I know many friends who have funds, many people even who announced that they are raising funds, and even in some cases, people who announced they already raised funds, where it turned out that many of the commitments they thought were there were not there. Many people don't know a lot of the nuances of raising a venture capital fund, and maybe it's a deep dive episode for another day and how it's different from a startup. But it can be a much longer process, and it can be a lot harder to know at various stages of the process whether you are going to succeed at all. And so it definitely was quite a test in a lot of ways, but very fortunately for us, or at least almost all of our Fund 1 investors re-upped into Fund 2. Most of them put more in. We had one investor who 10x'd the size of their allocation from Fund 1 into Fund 2. And having that basis with a bit of a track record, a couple of exits, allowed the foundation to then go to really the next level up in institutional LPs, publicly traded companies, some of the largest financial institutions in the US, owners of the biggest and most valuable professional sports teams, some of the top performing venture capitalists of all time, to go to them and say, look what we've built. All of our investors from Fund 1 are so happy with how it's going that they're supporting us and coming back into Fund 2. Here's a couple of the deals that we have lined up, and here's what we can bring you in terms of value beyond financial returns. Fortunately, even amidst a really, really tough backdrop, that was a narrative that resonated. And trust me, we got many more no's than yeses, but we got enough yeses to get over the line and get to the point where we now are eagerly and happily writing checks into some really, really amazing companies.
One question, Lloyd, and then I'll leave it over to Benjie. So one question. So Lloyd, can you talk as well about do you have to justify sometimes when you give pitches to get investment into your fund of why investors should invest into our industry specifically? So you are looking to make investment into sports, gaming, and entertainment. Do you have to justify why that is an area where investors and wealthy funds and so on need to deploy their capital into, as opposed to other technological verticals? Obviously
investors want to hear why I'm interested in a particular space and what the secular tailwinds are that can create growth just from the beta of the trade. I think the thing that people need convincing of currently are not to invest in sports or not, but whether to allocate to an illiquid long-term lockup like venture capital. And those who do want to invest in venture capital, generally it's a small portion of your overall allocation. And that portion of your overall net worth or portfolio that's going to venture capital, you're looking for outlier returns. You know that your investment might go to zero, but that if it succeeds, it'll be 10, 20, 30x your money back. That's generally what people are looking for from a venture capital allocation. And in order to invest in and attain outlier returns, you need to invest in outlier people with outlier strategies and outlier ideas. So really the bigger thing that I or anyone in my shoes needs to convince someone is that venture capital is a good asset class for a certain subset of strategies, and that there are attractive returns even if they lock up their money for 10 years. And that once they are open to that idea, that within the universe of opportunities that exist, I am someone who can generate outlier returns and produce extreme outcomes. And in my particular case, I happen to explain why sports gaming and entertainment is the vessel through which I can invest behind my competitive edge. But I actually very openly say, usually, there are many great places to make money in the current market. There are many great venture capital opportunities in the current market. I invest where I have an edge today, which is sports gaming and entertainment. And that's what my pitch is on, investing behind a particular competitive edge, not that this industry is inherently a better opportunity than others.
Question on my end, Lloyd. Obviously you had the first fund, which is still ongoing. I'm just kind of curious how you kind of, think about this on a continuum. And if we go back to the first fund and to the day that you kind of got that going, and it wasn't that long ago, I recall when you got that going, and, we're now a few years later. You didn't know then what you didn't know, and you don't know now what you don't know, which we'll probably talk about when you get to Fund 3 one day. But what are some of the takeaways from the ongoing experience of this first fund that will dictate what most of your investors must believe will be the enhanced success of the second fund?
It's funny. When I look back to raising Fund 1, I almost can't believe anyone gave me money for that fund, because I, in retrospect, didn't know what I was doing compared to how I feel now. And I recognize when I step back and do a self-assessment, that's just what growth feels like. If you don't look back and almost recoil in cringiness from how you used to do things a few years ago, it means you're probably not improving at a fast enough rate. And there is really one specific dimension that I understood intellectually but had not internalized in a way that I have now. And that, you guys have heard me say it so many times, but it's the importance of the founder. There's a reason why we now apply the test. Is this a founder whose earnings we want to own a future stake in, regardless of what they are pitching? We only have maybe made a few miscalculations. I have over my entire course of investing, and all of them have been of the same variety, which is thinking or hoping that an A+ product opportunity, TAM, idea, whatever, can outweigh a B+ or even A- founder. And the reality is that to actually take a company, an idea from your mind and put it out into the world and take that thing to a multi-billion-dollar IPO, you need to be an A+ founder, because A+ founders can recruit other A+ engineers and folks for the company. And I think we have just become religious about backing those type of founders. And as a subset of that, really have leaned into the feeling that how you do anything is how you do everything. And that you can really learn a lot about, Benjie mentioned before, just some of the back and forth that you're having, founder and investor, and how people answer questions. And there's so much more information that I think you can glean from basic conversations if you believe that how you do anything is how you do everything. So those, and then finally, I think, first time fund, it's easy to say that you want to be an independent thinker and be immune to crowd think and group think. But man, first of all, one thing I learned is really how hard that is when you're in the middle of a hype cycle and all the smartest investors that who have had tons of success for decades are piling into the same deal together. You can read all the textbooks you want. It is very hard to sit in those shoes and say, no, I'm going to be the one person who thinks this deal is overvalued or not a good idea. And one, I definitely have gained an appreciation for how hard it really is to have that level of conviction and independent thinking in the face of a lot of incomplete and missing information, but also how important it is. And certainly, I think one difference you'll see in Fund 2 is Fund 1, almost all of our portfolio companies are invested in with roughly the same group of co-investors. There's a few outliers here or there. You're going to see the next few deals we announce are with some new investors that a lot of folks in this space have certainly heard of but haven't seen in deals before, or you're going to see us blend new themes and verticals and revenue streams that maybe some people don't totally have an eye on. So religious focus on founder caliber and just an absolutely unabashed willingness to be an independent thinker and go against the grain and go against the crowd when we have conviction. That's what I hope at least our investors for Fund 2 are really betting on.
Lloyd, as a final question for you here today, you talk a lot about, of course, that you prefer to look at talented founders rather than A-plus products, let's say, if you got to choose between the two. But can you talk a little bit more about who should contact Lloyd, right? So if founders are listening into this today, which founders are you and which type of companies are you particularly into to talk to? And can you also talk perhaps about what will you as a fund contribute to the opportunity other than just money?
So first of all, to be clear, an A-plus product is not an indictment of a company. Rather, an A-plus product is usually an indication that you might have an A-plus founder. And so having A-plus product, pitch deck, pitching abilities, market research, all of those things are part of the assessment. So please, if you have an A-plus product, don't take this call to mean you shouldn't reach out to me. You definitely should. We invest in this phrase I use, competitive entertainment, anything that gets you to lean forward in your chair, that gets you to really focus and have your attention captured in a way that most things outside of sports and gaming just don't really allow for. That's something we want to be involved with. I hesitate to name specific themes because, frankly, we want to invest in founders who tell us what the themes are going to be, as long as hopefully those comport with our larger view of the world and how it's evolving. And then finally, we think of ourselves as something of a one-stop shop for companies in this space, whether you're B2B or B2C. Pretty much anything you could ever want as a sports, gaming, or entertainment startup probably exists within the confines of our LP network. If you're trying to pitch software for sports stadiums or sports books or sports media companies or advertising networks, most of the largest stakeholders in the world in each of those groups are LPs in our fund and invested in our fund so that they can see the hottest, latest, and greatest technology companies for the sake of making further investments or commercial agreements. And so very much looking for folks who are looking to be plugged in, optimized for probability of success, playing long-term games with long-term people, and building cool stuff that helps people just have some fun, because that's really what this whole industry is all about at the end of the day.
I know we're out of time here, Pierre, but I know that we're out of time here, Pierre, but I will kind of conclude by saying that as someone who has seen Lloyd co-invested with him on some deals and just seen the level of diligence and his work ethic and his commitment to doing the right thing by both founders and by LPs and his overall knowledge of the industry, I think that I can say that those LPs who are participating have put their money in very, very capable hands, and look forward to seeing what happens over the years ahead. So
very much appreciated. Very much.
Very excited to see the next step. Hello, we are excited to continue to report on all the investments that you make in the future. Guys, thank you so much for today. It's been another great episode of the Vested Into podcast. I wish you guys a great summer day, and we'll see you here next month. Thanks so much, Lloyd.
Thanks, guys.
Bye, guys.